Okay, so we're going to talk about reporting on the financial condition of the business. There's two financial statements. There's the income statement and the balance sheet. So the income statement, this is the one everybody's very familiar with. How much did I bill my customers? What were my cost of goods sold? What were my expenses? That's all on the income statement. The other financial statement is the balance sheet. This is the one that most people struggle with and that they don't understand. So today, I hope by the time you all leave that you have a better understanding of both of these financial statements. So the balance sheet is what are all the assets that I own, all the liabilities that I have with vendors and credit cards and things like that, and then the difference between those two things is our equity. So let's start with a little deep dive on the income statement. So the income statement is an equation. I have income, subtract all my expenses, and the difference is profit. If I were to look at it in a graph, in a picture, if you're falling below zero, that yellow section is your profit, you're losing money. Okay, some people like to look at it in words, some people like to look at it in pictures. So this is what it looks like when you print it out of QuickBooks or another accounting software. Your revenue is at the top, all your expenses, and then your profit at the bottom. Hopefully it's a profit. There are a couple extra sections that we work really hard, like especially in the Service Nation Alliance and Service Roundtable, to establish a cost of goods sold section. You could just put everything in as an expense, but it's really important when you're analyzing, when you're doing more of the accounting side, to separate cost of goods sold from your overhead expenses, because that's going to give you a gross profit. And that gross profit, when you break it down into percentages, is going to help us figure out what your break-even point is. How much do I have to sell to cover my overhead? So you've got to be able to distinguish cost of goods sold from expenses. Cost of goods sold are the things that are directly related to your producing your revenue. So it's your job materials, your direct labor. It's not your administrative people back at the office or your office supplies. Those are overhead. You see the difference? Okay, good. And then at the bottom of the income statement, you'll often see what's called extraordinary income or other income and expenses. So what that is are things that happen that are outside the norm. Like let's say you have an insurance claim settlement where you got a big check because you got a fire in your building or something. That's not hopefully not part of your normal operating income, and so it's below the line. That's what they call it, below the line.